Now, Wayne Swan has to go down as one of the best super dupers of all time with the deceptive curveballs he threw at the country on Friday. And it's because of this I say don't believe some of the most respected political commentators in the country, many of them are my mates, when they say only 16,000 of the fabulously rich will be affected by the Gillard government's proposed changes to super. There will be more, it could be hundreds of thousands, and the only reason why most of our great commentators swallow the Treasurer's bait hook, line and sinker is they simply don't understand super. Now, being a financial advisor with real clients and doing a radio segment talking about super and finance 4 nights a week on 2GB, these are the reasons why I know they have been duped. While the press release said 16,000 will be affected, I'm sure the Treasurer actually said 20,000 in the actual press conference. But even this number could be way off the mark. So what's the reason behind the 16,000 number and the $100,000 threshold? The Treasury calculation is as follows. Using 5% as the expected return, 5% of $2 million is $100,000. If you do better than 5%, then the additional amount over $100,000 will be taxed at 15%. That's presuming you've got $2 million in your fund. However, as one caller to 2GB told me on Friday night, he said, I've got $750,000 in my super fund and made 14% last year, which would put me over the $100,000 mark. When I saw the details of the actual press release, I made the point on Sky News Business on the actual morning that if someone had $1 million in super and made 20%, which some of our subscribers in the Switzer Super Report actually did make, then you would be up for $200,000, and so you would be taxed at 15% on the $100,000 over the $100,000 threshold. If the stock market went up by 20% for a few years, then there would be a Treasury windfall, and this super tax on those who've saved a lot through super will be the ones kicking into the can. These changes will be lucky to get through, but I think over time we will see super changes, and the wealthier you are, the more likely you will be the cow that will be milked. Now, many investors are using self-managed super funds to avoid paying capital gains tax on their investment properties. Figures from the ATO reveal investments in direct residential properties jumped 45% last year from 2008 to $15.4 billion. But what are the positives and negatives of investing in property inside or outside your self-managed super fund? For more, we're joined by Tony Negline from Financial and Technical Solutions. And Tony writes for the Australian newspaper and also writes for the Switzer Super Report. And why? Because he knows his stuff. Hi, Tony.
How are you, Peter?
Now, you heard my rant, as Janine would call it.
Yep.
Look, I know you're not a political kind of guy, but when you heard the $2 million funds only being affected and 16,000 people, you must have shook your head and said, hang on, it could be hundreds of thousands, surely.
Well, the devil is going to be in the details, so I would be surprised if it's limited to 16, even 20,000 people. The details are a little bit thin on the ground, so we're going to have to wait and see how they define things such as income, how they define capital gains, how they define unitisation in very large funds, and so on. So I think 16 is probably a little bit light on. You could easily double that. All you need is, say, 200 grand in a fund. It does particularly well. You decide to flog the asset that's in a fund. You make a big healthy capital gain, and there you go. You're beyond the threshold. So it's really not that hard.
Now that's a good point. If you happen to sell your shares, you might think a stock market crash is coming. I want to liquefy and go into a term deposit, and wacko, they've got you.
Correct. Yeah.
And that's why you're on the program, because that's a point that hasn't been made, even in my ranting and ravings. That's a very good point. I was thinking more along the idea of someone selling a property of a fair bit of money with some capital gain. But you're right, someone could easily be stung with a small portfolio.
Oh, look, if you're very lucky, if you happen to buy, let's say you buy and trade penny dreadfuls, and some of those, go from one cent to 20 cents.
Even Tony, even if you bought Telstra when it got down to about $2.43, and you're going close to doubling your money, and you liquefy that, there's going to be a fair bit of capital gain there.
Correct, as well as the dividends and and so on. So it's not going to be that hard for people to blow that 100 grand threshold. And really at the end of the day, someone wanting, there's a lot of people who earn $100,000 or more. I know according to tax office statistics there aren't, but there are a surprising number of people who earn 100 grand a year who would need to retire on that sort of level of income. And so, you know, I just don't like this rhetoric where they say that, you know, anyone who earns $100,000 a year is part of the, you know, this super rich type thing. I think it's a bit over the top.
Yeah, well, I've always used this analysis when people would ask me, you know, clients or friends, they say, how much should I have when I retire? And I said, well, it'd be good if you could have $1 million for this reason. You can, most financial planners work on a return of about 7% in a conservative kind of way. So 7% of $1 million is $70,000. Now, that's not a massive amount of money. Sure, people can exist on 40 and 50, but if you want to be a comfortable retirement, 70,000 would be very good. So you need $1 million going in, and if the stock market went up for 20%, say 3 or 4 years in a row, which it did in the noughties, well then you'd be over the limit all the time and always paying tax.
Yeah, correct. You're spot on. And so, you know, are they going to go down the other route, whereby, you know, they might just turn around and say, okay, we're now going to tax pension funds overall. So I think, you know, that to some extent the dam has been burst, and now it'll be interesting to see which way they actually do end up going, because this new mechanism is a shocker for large funds to run. I don't think it's too hard for a self-managed super fund. It's just a little bit more data, the tax office, a bit more auditing, few data fields and so on, and you wait for how much tax has got to be collected, ignoring the fact that no one likes paying the tax. But from an operational perspective, for self-managed funds, it's a bit of a pain in the neck, but it's doable. For large funds, it's just horrendous.
Tony, go on.
No. I just think for large funds, it's absolutely horrendous. So I don't think anyone's necessarily going to really like the process that they have put in place. Because the large funds are going to have to send data to the tax office. They're going to have to wait for the information to come back, how much data to pay. There's going to be errors. It's exactly the same it'll be exactly the same process as excess contributions, and we all know what a horrible mess that is. And even after the announcements that they made on Friday in relation to excess contributions, it's still going to remain a horrible mess. So we're going to have
Tony.
Yep.
Okay, I've got a question from a viewer/reader who said, I've got 740k in my super. Now, he said, my wife's on a pension. Is it possible for a husband to be on a super fund pension, and she could be on a government pension?
Yes. Now, my assumption, one of the things I would assume here is that his wife is over 65 or at least 65 and receiving the age pension, and he is under 65, which means that his assets are not counted as an asset and are not deemed. If he was over 65, all their assets would be combined, and any super assets that were not being used to take a pension would be subject to deeming. So that's how they've managed to, if you like, escape the counting of that 700 odd grand.
Now he said if I die, then the money in his super fund goes to her.
Yep.
He said, well, all that money going over to her, well, she'd be, you know, really slugged straight away, wouldn't she? Because she'd be all of a sudden she'd have an enormous amount of money coming to super, and he was worried about the Centrelink implications. Can you explain to our viewers what would happen there?
Okay, in that situation, if let's say he died tomorrow, in that situation, those assets would then be transferred to his wife's name. In that situation, that asset would be counted in her name. And she would blow the asset test threshold, so she would probably lose the age pension at that point in time.
Yeah, and I think he was worried about all the other things like, you know, the hospital and all that sort of stuff as well. But look, then all of a sudden she'd have 740 in there. Now, when that money comes in, that won't be treated as income and affected by the threshold. It would simply be a contribution to her fund.
Well, it depends on what he was doing. In the fund, they may be able to take that asset, and also whether or not she wanted income from it. That depending on how it was run, she may be able to take that asset as a pension, as an account-based pension or similar, or she might want to take it as a lump sum and then invest it, or if she's allowed to contribute it back into super or whatever.
Yeah, effectively a rollover for her, wouldn't it, in a sense?
Yes, but she'd have to take it, if she wanted it as a lump sum, she'd have to take it into her own name and then make contributions with it.
Yeah, okay. But this is the sort of things that happen when strange superannuation rules change. People start panicking about the implications of it. All right, Tony, the thresholds. the thresholds are supposed to be adjusted to the CPI and then bumped up by $10,000 lots. What's the history of governments actually keeping promises on adjusting tax thresholds?
Pretty slim pickings, I'm afraid. We know that Howard Costello brought in the concessional contribution caps of 50 grand a year. Under the Rudd-Gillard government, it got punted down to 25 grand. They did agree to index the concessional contribution cap by movements in average weekly earnings. They've dropped that for a period, for quite a few number of years. So I think the history of them indexing thresholds. Look at the normal income tax thresholds. They are never indexed. So they don't. No government of any persuasion has much of a track record in that respect.
Okay, let's just now talk about the implications for someone who bought maybe a property inside their self-managed super fund. They might have bought it, say, 2 years ago. How are they going to be affected by these new rules?
Well, if they bought the asset, so they've got a lumpy asset, it's when they sell it that's going to drive a lot of their decisions. So if they sell it in pension phase, that any capital gain they make may be counted and then subject to tax. But then, so that they're going to have to sit down and do some very, very serious planning. And I think one of the points you made before is that when these rules are brought into play, people tend to panic. But I think what people will have to do is that they will have to sit down and plan. You would see in your financial planning business, and a lot of financial planners would see, people don't give this enough time and energy. And they're going to have to swing that around, and they really are going to have to sit down and think, okay, well, when am I going to sell an asset? How am I going to sell an asset? And all those sorts of things, and think through the tax implications of all of that.
Yeah, and so basically, if someone bought it, say, 2 years ago, it's inside the self-managed super fund. If they sell it within 10 years, they will be governed by the old rules?
No. The asset will, the asset, all of the, there is some grandfathering, but then that grandfathering tends to die. So you've then got any capital growth from a period of time that is then going to be assessed. So at a period of time, everyone is going to, under the proposal, everyone is going to have to value their assets and work out, where they're at, and then work out any capital growth after that transitional date. So every asset is going to be trapped at some point in time, if it's owned, in about 10 or 11 years' time.
Yeah. Okay. So the fact that you got in before this rule change doesn't give you a capital gains tax holiday compared to someone who buys a place tomorrow.
Correct. So everyone is going to have to sit down and think about these things in as I said, in quite a amount of detail, and say, okay, what's the net asset? What's the net value of this asset? Should we sell it now before we have too much tax to pay? What should we do? So there's going to be a lot of it's I suppose to some extent it's great for the economy overall, because I suppose it's forcing people to do things which cost money. So there's money to be made for people who are buying, selling assets. But it's if you like, it's forced transactions really, which may not necessarily be good for the investor themselves.
Yeah, and I think it rattles a lot of people who've made decisions about their retirement based on the rules as they existed, and that's the main reason why I call the Treasurer a super duper. All right, Tony, thanks for joining us on the program.
My pleasure, Peter.